Forget everything you think you know about the Age of Discovery. It wasn't born from noble quests for knowledge or pure adventurous spirit. It was launched by a single, staggering, obscene number, 400%. That was the average profit margin on a single, successful spice run from the Moluccas to Europe in the 15th century. A single ship could transform a merchant guild into a sovereign power, a sailor into a kingmaker. This is not a story of maps and stars. This is a story of the first true global commodity cartel. A cartel so powerful, so ruthless, and so profitable that it literally forced the world's geography to be redrawn. The Age of Discovery wasn't an age of heroes. It was the opening chapter of high-stakes, blood-soaked financial warfare, where the ultimate collateral was human life, and the prize was a monopoly on taste itself. Welcome to the ledgers of the Spice Cartel. To understand the economic detonation that was the spice trade, you must first discard the modern idea of money. In the dust-choked counting houses of 15th century Europe, the most reliable store of value, the most sought-after unit of account, was not a coin stamped with a monarch's face. It was a small, wrinkled, pungent berry, Piper nigrum, black pepper. Before the age of central banks and fiat currency, Europe operated, in crucial ways, on a spice-based monetary system. Pepper was hard currency in its most literal sense. Its value was extraordinary and remarkably stable. A Venetian merchant could use a sack of peppercorns to pay a debt in London with more certainty than using Florentine florins, whose gold content might be debased. It was used to pay rents, hence the term peppercorn rent, for a nominal fee. It settled taxes, sealed dowries, and even paid ransoms for captured knights. In 1189, the ransom for the Duke of Austria was set at 150 quintals of pepper. This wasn't a quirky detail. It was a reflection of pepper's supreme liquidity and universal valuation. A chest of pepper was a bearer bond, a hedge against the inflation that constantly plagued silver and gold coinage as kings clipped edges or mixed in base metals. The demand was not merely culinary. It was institutional and financial. This created the foundational, non-negotiable demand shock that would ignite the economic calculus of exploration. Yet, the supply chain for this black gold was a masterpiece of obscurity and exploitation, a multi-layered cartel stretching over 10,000 miles. Muslim traders, primarily from the Levant and Egypt, controlled the routes from the Indian Malabar coast to the ports of Alexandria and Beirut. From there, the Venetian Merchant Republic held a stranglehold on the Mediterranean leg, transporting the spice to its markets and distributing it north into Europe. Each link in this chain, the Indian producer, the Arab dhow captain, the Egyptian customs official, the Venetian galley master, added not just a logistical cost, but a monopoly rent. They were price makers, not price takers. By the time a pound of pepper reached a Parisian apothecary or a London grocer, its price had been multiplied by a factor of 50 or more. This final price reflected not the cost of production or transport, but the accumulated economic tribute extracted at every geographic and political choke point. The system was brutally efficient for its middlemen, but it represented the ultimate market inefficiency for European consumers and monarchs. It was this inefficiency that presented the singular profit opportunity of the pre-modern world. Princes and financiers gazing at their ledgers saw a breathtaking equation. The cost of pepper at its source in Calicut was a tiny fraction of its selling price in Antwerp. The gap between the two numbers, the spread, was pure, extractable profit, waiting for anyone who could bypass the entire parasitic network. The Portuguese crown, teetering on the edge of Europe and hungry for wealth and prestige, didn't just see an exotic luxury trade. It saw a chance to execute a vertical integration on a transoceanic scale. The goal was not to join the existing supply chain, but to annihilate it. By sailing directly to the source, they could replace the dozen middlemen with a single, state-controlled pipeline. This would allow them to capture not just a merchant's margin, but the entirety of the astronomical markup for the royal treasury. The Age of Discovery, therefore, began not with a dream of new lands, but with a cold, clear vision of a balance sheet. The caravels were not just ships. They were floating arbitrage vehicles, and their cargo holds were meant to be filled not with wonder, but with the most potent financial instrument the world had ever known. The romantic image of Prince Henry the Navigator gazing wistfully from Sagres is a myth. His maritime school was, in essence, the world's first dedicated venture capital research and development lab. Its mission was not philosophical. It was to de-risk and capitalize on the geographic arbitrage opportunity presented by the spice price spread. The financial model was terrifyingly simple, yet the inputs were monstrously uncertain. The capital expenditure, capex, for a single expedition was colossal. Building a caravel, stocking it with provisions for a year or more, and paying a crew represented a fortune. But the operational risk was what truly defined the calculus. Navigation was guesswork. Mortality rates from scurvy, shipwreck, and conflict routinely exceeded 50%. An investor had to accept that there was a significant chance their entire capital investment would vanish into the Atlantic, with no return and no recourse. To justify this, the potential return on investment, ROI, had to be astronomical. Financiers and royal treasuries performed brutal cost-benefit analyses. Let's use conservative historical estimates. A voyage might cost 10,000 Portuguese cruzados to outfit. This financial logic triggered a speculative investment bubble in exploration. It wasn't just the Portuguese crown funding these missions. Genoese and Florentine bankers, seeing a chance to break the Venetian monopoly that choked their own profits, poured investment capital into Portuguese ventures. The capital allocation decision was clear. The potential upside from capturing even a fraction of the spice trade dwarfed the returns from any domestic enterprise. This risk-tolerant capital environment financed the iterative technological improvements. The caravel, the astrolabe, improved cartography, not for science, but for logistical efficiency. Every knot of speed, every degree of navigational accuracy, reduced the project timeline and the risk window, directly improving the probability of that 400% profit margin. The explorers were, in the ledger books, project managers and logistics officers for the highest-stakes speculative cargo runs in history. Their destination wasn't a place on a map, it was a line item on a profit and loss statement. When Vasco da Gama's battered fleet finally dropped anchor off Calicut, India, in May 1498, he was not performing a cultural exchange. He was executing a hostile market entry on behalf of his sole shareholder, the Portuguese crown. His mandate was not to explore, but to establish a direct procurement channel. The famous, often ridiculed gifts he presented to the Samudri, Zamarin, ruler, striped cloth, wash basins, honey, were not a naive error. They were a lowball opening bid, a test of the market. When the local Arab merchants, who controlled the spice exchange, scoffed at his goods, they weren't insulting his taste. They were defending their monopoly pricing power. Da Gama's response was the true reveal of his mission's nature. He didn't offer better terms. He displayed his ship's cannon. This was a coercive negotiation tactic, the first salvo in a new form of commercial imperialism. The message was a financial ultimatum. You will sell to us, at our prices, or we will use force majeure to destroy your existing supply network. Da Gama was not a merchant. He was a corporate raider armed with the state's military assets. His initial commercial haul was modest, but its symbolic financial value was infinite. The spices he brought back to Lisbon in 1499, pepper, cinnamon, ginger, were sold at auction. The total revenue eclipsed the cost of his entire expedition by a factor of 60. This wasn't just profit, it was a market-signaling event of seismic proportions. It provided empirical proof that the arbitrage model worked. The 400% profit margin was not theoretical, it was bankable. The immediate economic consequence was a speculative frenzy in Lisbon. The success validated the entire investment thesis of the Portuguese exploratory program. Capital flooded in. The crown moved swiftly to institutionalize this success, transforming a daring venture into a systematic extractive enterprise. In 1505, they established the Estado da Índia, a state-administered monopoly corporation with its headquarters in Goa. The Estado was not a traditional colony. It was a vertically integrated supply chain management entity with its own military, judicial, and fiscal authority. Its primary KPI was margin capture. Da Gama's voyage had de-risked the operational model. Now, the Estado's job was to scale it up, systematize the extraction, and defend the monopoly against all competitors, whether they were Arab dhows, Indian merchants, or, soon, other European powers. Da Gama didn't discover a sea route. He discovered a financial shortcut that turned Portugal, almost overnight, from a peripheral European kingdom into the core of the world's first globally integrated commodities cartel. He was less an explorer and more the founding CEO of Spice Incorporated. The Portuguese crown understood that controlling a single port in India was not enough. To secure the 400% profit margin, they needed to dominate the entire value chain. The Estado da India was their revolutionary instrument, a hybrid entity that was part government, part trading company, and part private army. Its strategic objective was cartel economics on a maritime scale, seize and fortify the critical choke points in the Asian spice network. This wasn't colonization for land. It was infrastructure acquisition for logistical control. Key nodes like Hormuz, Persian Gulf, Goa, India, and Malacca, the strait controlling access to the Spice Islands, were captured not to rule populations, but to tax every single vessel passing through. The primary enforcement tool was the cartas, a naval pass issued by the Portuguese. To trade legally in their waters, any merchant vessel, Arab, Indian, Javanese, had to purchase this document. Refusal meant your ship was fair price, subject to seizure and confiscation. The cartas system transformed piracy into a state-sanctioned, toll-based revenue model. It was a protection racket codified into international law. This allowed the Portuguese to monetize the trade they didn't even carry, extracting a rent from the existing Asian commercial network while simultaneously forcing spice cargoes onto their own, tax-advantaged ships. The profit margin was thus protected by a military barrier to entry. However, this model suffered from a critical structural flaw: immense fixed costs. Maintaining a fleet of heavily armed carracks, manning a network of stone fortresses from Africa to Indonesia, and fighting constant low-level wars was ruinously expensive. The operating leverage was extreme. In years of high spice prices and smooth operations, the cash flows were staggering. But any disruption, a failed monsoon affecting harvests, a naval defeat, a blockade by the Ottomans in the Red Sea, could instantly erase profits. The Estado was a high-overhead monopoly, constantly struggling to convert its gross revenue into net profit. The very violence required to maintain the monopoly devoured the profit margins it was meant to protect. This created a vulnerability that a competitor with a more capital-efficient and financially innovative structure could exploit. The Portuguese built a fortress of a cartel, but its walls were mortgaged to the hilt. The stage was set for a corporate raider with a better business model and a deeper war chest. That competitor emerged from the swampy, mercantile heart of the Netherlands. Frustrated by high Portuguese prices and embargoes during the Iberian Union, Dutch merchants made voyages of discovery that were, in fact, industrial espionage missions. They returned with maps, sailing logs, and samples. In 1602, they pooled their resources not into a loose consortium, but into a financial and legal revolution. The Verenigd Oost-Indisch Company, the Dutch East India Company, VOC. The VOC was unlike any entity before it. It was the world's first publicly traded, limited liability, joint stock company with a permanent capital base. Its charter granted it a 21-year monopoly on Asian trade, but more crucially, sovereign powers, the right to wage war, imprison, execute, negotiate treaties, and mint coin. This structure was a masterstroke of financial engineering. Unlike the Portuguese crown, which funded the Estado from its finite tax revenues, the VOC could raise near limitless investment capital by selling shares to the public on the Amsterdam Bourse. Its permanent capital meant it didn't have to liquidate after each voyage to repay investors. It could plan decades-long strategies, fund standing armies and fleets, and weather short-term losses for long-term market dominance. Shareholders were motivated by dividends and capital appreciation, not the glory of a king. The VOC was, in essence, a nation-state Inc., where the board of directors, the Heeren 17, were answerable to a shareholder assembly, not a monarch. Their business strategy was to achieve operational supremacy. They built larger, more specialized cargo ships, flights, that required smaller crews, drastically reducing unit labor costs. They established a network of fortified trading posts, factories, optimized for inventory management and just-in-time logistics, minimizing holding costs. They waged war not just for territory, but to enforce exclusive purchasing contracts and destroy competitor supply. The VOC didn't just want to trade spices, It wanted to control production at the source to dictate global supply and therefore price. They entered the market not as traders, but as a vertically integrated, financially sophisticated, state-backed corporate predator. Their target was not just the spice trade, but the complete financialization of the Asian maritime economy, with the VOC as its central, indispensable processor. The Portuguese had weaponized trade. The Dutch were about to corporatize conquest. The purest, most horrifying expression of the VOC's monopoly strategy unfolded in the Banda Islands, a tiny archipelago in the eastern Indonesian Sea. These 10 islands were the sole global source of nutmeg and mace. For the VOC, controlling the pepper trade was profitable, but controlling a natural monopoly was the ultimate prize. They did not seek trade with the Bandanese. They demanded absolute sovereignty and exclusive purchase rights. When the Bandanese, who had a complex trading network with Javanese, Malay, and even English merchants, resisted these terms, the VOC's response was corporate policy enacted as genocide. In 1621, Governor-General Jan Pieterszoon Cohen arrived with a fleet and a full army. What followed was a calculated campaign of extermination. Villages were burned. Thousands of Bandanese were slaughtered. Thousands more were enslaved and shipped to Batavia, Jakarta. The remaining population starved or fled. Conservative estimates state 90% of the native population of 15,000 was killed, enslaved, or exiled. Cohen then repopulate the islands with indentured laborers and slave plantations under direct VOC management, turning them into company-owned agribusinesses. This atrocity was not a colonial outburst. It was a coldly rational business decision. Independent producers created supply uncertainty and price volatility. By eliminating them, the VOC could now control production quotas with precision. They engaged in planned obsolescence of a different kind. They would burn warehouses full of nutmeg in Amsterdam to artificially restrict supply and prop up prices in Europe. The Bandanese were not killed for their land, but for their market share. Their existence was a liability on the VOC's path to 100% market dominance. The massacre demonstrated that in the pursuit of monopoly profit margins, human life and sovereignty were merely externalities to be eliminated. It was the logical, ghastly endpoint of viewing commerce through the lens of absolute financial control. The VOC didn't just trade spices, it engineered scarcity, and human beings were the first variable to be removed from the equation. The staggering risks and long-time horizons of the spice trade didn't just move commodities. They invented the modern machinery of finance. In the taverns and exchange yards of 17th-century Amsterdam, traders grappling with uncertainty created the precursors to today's derivative markets. The core problem was price volatility over a 2-year risk horizon. A ship leaving for the Indies carried with it a massive price risk. What would pepper be worth when it returned 24 months later? To manage this, merchants began writing forward contracts. A baker in Antwerp could contract to buy 100 pounds of pepper from a ship's captain next year at a price set today. This locked in his future cost, acting as a hedge. These forward contracts soon became tradable themselves. If the baker's needs changed, he could sell his contractual right to another buyer before the ship even returned. This was the birth of the secondary market for risk. From this evolved options contracts, opties. An investor could pay a premium for the option, but not the obligation, to buy spices at a set price in the future. This allowed for leveraged speculation on price movements without the need to take physical delivery. The Amsterdam Bourse became a roaring pit of such paper trades. The value of a VOC share, or a futures contract on nutmeg, would swing wildly on rumors of a shipwreck, a war in the Moluccas, or a frost in the Alps affecting overland routes. For the first time in history, the global supply chain had a real-time financial proxy. The weather in the Banda Islands, the health of a sultan in Gujarat, the loyalty of a mercenary garrison, all these distant, physical realities were now encoded into the price signals of a liquid, speculative market in northwestern Europe. The spice trade had financialized geography. Capital was no longer tied directly to a physical ship. It could flow into and out of abstract claims on future production. This innovation provided liquidity and risk distribution, making it easier to fund ever larger ventures. But it also detached finance from tangible assets, creating the potential for speculative bubbles. The tools built to hedge the risks of the spice trade became the very engines of capital market speculation that would, centuries later, power the global economy and its crises. Chartered just 2 years before the VOC, the English East India Company, EC, began with an identical goal: crack the spice arbitrage. They were brutally shown the door. The VOC, with superior capital and localized power, violently enforced its monopoly in the Spice Islands. The climax was the Amboina Massacre of 1623, where VOC officials tortured and executed 10 English traders on false charges of conspiracy. This was more than an atrocity. It was a strategic market signal. The message to the EIC was clear: the high-margin spice trade in the archipelago was a closed shop. Forced into a strategic pivot, the EIC made a decision that would ultimately define the British Empire. They diversified. They shifted their focus to the Indian subcontinent, a market the Portuguese had tapped but not dominated, in which the VOC considered secondary to the Spice Islands. In India, the EIC didn't just seek to control trade. They moved up the value chain. They established factories that evolved into fortresses and began to manipulate local politics, offering military support to regional rulers in exchange for exclusive trading rights and tax exemptions. They moved from buying finished textiles to controlling their production. More importantly, their commodity portfolio broadened. While spices remained a line item, the real money came from Indian cotton textiles, calicos, indigo dye, saltpeter for gunpowder, and later, Chinese tea and Bengali opium. This diversification strategy was a crucial risk management innovation. The VOC was a pure-play spice stock, hyper-exposed to the volatility of a few luxury commodities. The EIC became a conglomerate, a portfolio manager of colonial assets. When the spice market eventually crashed due to overproduction, the VOC was devastated. The EIC, with its diversified revenue streams, weathered the storm and grew stronger. The English learned that in the long-term game of empire, diversification and political embeddedness could be more powerful and ultimately more profitable than a violent monopoly on a single product. They turned from being spice traders to being the administrators of a vast extractive economy. What economic force in Europe could possibly sustain these astronomical profit margins for centuries? The answer lies in inelastic demand driven by social signaling. Spices were the ultimate Veblen goods of the pre-industrial world. Their high price was intrinsically linked to their desirability. In an era before brand-name luxury goods, a banquet was a public financial statement. Lavish use of black pepper, cinnamon, cloves, and nutmeg was conspicuous consumption on a plate. It screamed wealth, power, and global connectivity. This created a demand that was relatively immune to price hikes. The European elite weren't just buying flavor. They were buying social capital and political prestige. This dynamic had profound macroeconomic effects. Pepper was so valuable it became embedded in the fiscal systems of states. It was used as collateral for international loans. Monarchs accepted pepper as payment for taxes, the so-called pepper tax. Its price volatility could thus directly impact royal solvency. Furthermore, the trade created a massive bullion drain. Europe had little that Asia wanted, so it paid for spices almost entirely in silver and gold from American mines. This constant outflow of specie contributed to price inflation across Europe in the 16th century, as more money chased a finite amount of goods. Economists of the mercantilist school saw this as a national catastrophe. Wealth was literally sailing east. Thus, the 400% profit margin captured by the Portuguese crown or the VOC shareholders was, in a real sense, a private tax on European aristocratic vanity, facilitated by a global imbalance of trade. The relentless pursuit of these luxury margins reshaped European society, fueled inflation, and provided the capital accumulation that would later fund the Industrial Revolution. The spice trade wasn't a sideshow. It was a central pump in the circulatory system of early modern capitalism, moving precious metals, inflating prices, and solidifying class distinctions, all powered by the insatiable human desire for status, now bottled, or rather, peppered. The VOC's ruthless efficiency in controlling spice production contained the seeds of its own destruction. Their monopoly strategy was predicated on artificial scarcity. But monopoly rents always attract challengers. The VOC's violent dominance inspired biological espionage. In the mid-18th century, Frenchman Pierre Poivre, literally, Peter Pepper, successfully smuggled nutmeg and clove seedlings out of the Moluccas. They were replanted in French colonies like Mauritius and later Grenada. The British did the same, establishing plantations in Penang and later Zanzibar. The natural monopoly was broken. The result was overproduction. By the late 1700s, spices were no longer rare commodities grown on a handful of secret islands. They were cultivable cash crops in multiple colonial territories. Global supply exploded. The VOC's desperate attempts to maintain prices, burning harvests, drowning cinnamon in the sea, became financially unsustainable against the tide of new production. The price arbitrage that had driven the trade for 300 years evaporated. The profit margin collapsed from 400% to levels comparable to other agricultural goods. For the VOC, this was a death blow. Its entire business model, its massive fixed-cost infrastructure of forts, ships, and armies, was built to defend a scarcity that no longer existed. The company was already bloated with corruption and bureaucratic inefficiency. As spice revenues plummeted, it could no longer service its debts or pay dividends. In 1799, after 197 years of operation, the world's first megacorporation was nationalized by the Dutch state, its assets seized to cover its immense liabilities. The spice market crash was a classic commodity boom and bust cycle. It demonstrated a fundamental law of economics. Extreme profitability protected by violence is a temporary market anomaly. Eventually, competition, innovation, in this case, botanical, and the law of supply and demand will correct the distortion. The VOC didn't just fail as a company. It failed to permanently repeal a basic economic principle. The most enduring legacy of the spice trade is not in our kitchens, but in our stock portfolios. The institutional and financial architecture built to manage pepper and nutmeg risk became the skeleton of global capitalism. The joint stock company, perfected by the VOC and EC, is the direct ancestor of every publicly traded corporation on the NYSE or NASDAQ. The concept of limited liability for shareholders, of permanent capital, of a board of directors accountable to shareholders, these were all refined in the fiery crucible of the spice race. The Amsterdam Stock Exchange, born from trading VOC shares and spice derivatives, established the template for every subsequent financial exchange. The secondary market for securities, the price discovery mechanism of open outcry, even the concept of a market bubble, like the tulip mania that shortly followed, all were pioneered there. The derivative instruments, forwards and options, created to hedge spice cargoes are the great-grandparents of the complex financial derivatives that underpin modern risk management and speculative crises. Perhaps the most profound legacy is the ideology of shareholder primacy. The VOC's directors were legally bound to maximize shareholder value, a mandate that justified genocide in the Bondi Islands. This established a precedent where corporate profit could be elevated above ethical, social, and even sovereign concerns, provided it delivered returns. The model of a state-chartered corporation wielding quasi-sovereign power has evolved into today's multinationals that can influence national policy. The spice trade financialized empire building, turning national glory into a balance sheet exercise. Every time you check a stock price, invest in a mutual fund, or hear about a corporate merger, you are interacting with a system whose core protocols were written in the 17th century to answer one question. How do we fund a ship to the Moluccas and capture that 400% profit margin? The spice traders built the operating system of modern finance. The parallels between the 17th century spice cartels and 21st century tech monopolies are not superficial. They are structural. Both represent the pursuit and defense of rent-seeking monopoly profits in a new, poorly regulated frontier. The VOC's control of the nutmeg supply chain is analogous to a tech giant's control of a proprietary digital ecosystem or user data. The walled garden of the Apple App Store or the Google Play Store is the direct descendant of the VOC's fortified trading post, a controlled space where the company sets the rules, takes a cut of all transactions, and excludes competitors. The use of sovereign-like power is another stark parallel. The VOC's charter to wage war mirrors the way tech giants use patent law, acquisitions of potential rivals, killer acquisitions, and lobbying to stifle competition, a form of regulatory and legal warfare. The network effects that make Facebook or Amazon so dominant are the digital equivalent of the VOC's control of logistical chokepoints like the Strait of Malacca. Once you control the essential infrastructure, you become indispensable. Even the financial metrics echo across centuries. The astronomical profit margins of big tech on digital services, often far exceeding the Spice Trade's 400% on near-zero marginal cost goods, are justified by innovation and scale, just as Spice profits were justified by risk and discovery. The regulatory backlash is also identical. Just as rival nation-states eventually broke the VOC's and EIC's monopolies through war and treaty, modern governments are pursuing antitrust lawsuits and digital market acts to break up data cartels and restore competition. The key difference is the nature of the scarcity. The VOC's power was based on geographic scarcity, a few islands. Tech monopoly power is based on data scarcity, exclusive access to user behavior, and algorithmic scarcity, superior AI. But the core economic playbook remains the same. Achieve market dominance through innovation and capital, erect barriers to entry through control of critical infrastructure, extract monopoly rents, and use the resulting profits to lobby, litigate, and acquire to perpetuate the cycle. The Spice Cartels wrote the first draft of the Monopoly Strategy Handbook. Silicon Valley is just running the latest, digital version of the code. This financial history forces a brutal reappraisal of the term Age of Discovery. It is a label bestowed by the winners. For the civilizations of the Indian Ocean world, the Swahili coast, the kingdoms of India, the sultanates of Southeast Asia, and the peoples of the Spice Islands, the arrival of Portuguese carracks and Dutch flights marked the beginning of an age of invasion, enslavement, and economic extraction. The profit margins celebrated in European ledgers were directly subsidized by mass violence, cultural destruction, and the systematic dismantling of existing trade networks. The capital that funded the European Renaissance, the scientific revolution, and the early stirrings of industrialization was, in significant part, primitive accumulation gained through this coercive, monopolistic trade. The wealth of Lisbon, Amsterdam, and London was built not just on ingenuity, but on predatory pricing, naval terrorism, and colonial subjugation. Viewing Da Gama, Cohen, or the EIC's factors through the lens of corporate management strips away the romantic hero narrative. They were CEOs, portfolio managers, and logistics officers executing a high-risk, high-reward business plan where the externalities, the lives lost, the society shattered, were never entered into the double-entry bookkeeping. Their moral ledger was kept separately, if at all. This perspective transforms the voyages of discovery into the opening campaign of financial globalization, a process that has always had winners and losers defined by power and capital. The true cost of the pepper that seasoned a noble's feast in Tudor England was not measured in the silver paid at the Antwerp Exchange, but in the blood spilled on the beaches of Goa and the Banda Islands. Recognizing this is not about assigning modern guilt, but about achieving historical accounting accuracy. The Age of Discovery was, fundamentally, the first project of global corporate finance, and its human balance sheet remains profoundly, tragically, in the red. The spice trade was the definitive, real-world laboratory for mercantilism, the dominant economic philosophy from the 16th to the 18th centuries. Mercantilism posited that a nation's wealth and power were derived from its bullion reserves, gold and silver, and that world trade was a zero-sum game. One nation's gain was another's loss. The goal was a perpetually favorable balance of trade. Export more than you import, and hoard the resulting specie. The spice cartels were mercantilism's ultimate instrument. The entire Portuguese and Dutch enterprise was designed to minimize the export of bullion by using force to acquire goods without fair payment, and maximize its import by selling those goods at monopoly prices in Europe. Monopoly companies like the VOC and EC were the perfect national champions. They acted as privatized extensions of state power, using violence to secure closed markets and funnel monopoly profits back to the state via loans, taxes, and dividends. The state, in turn, protected their charters with naval power. This system created a self-reinforcing cycle of imperialism. Profit margins from the spice trade funded bigger warships. Those warships captured more trading posts, which generated higher monopoly revenues, which funded further expansion. It was a philosophy of economic nationalism that explicitly linked corporate profit to state power. The 400% return was the key performance indicator of successful mercantilist policy. It justified any action, no matter how brutal, because it directly increased the national stockpile of wealth as defined by bullion. The spice trade proved mercantilist theory in practice, but it also revealed its fatal flaw. It was inherently conflict-driven and commercially restrictive. It would take the intellectual revolution of Adam Smith and the classical economists to argue that open competition and comparative advantage could generate more wealth for all nations than this system of state-backed corporate plunder. The spice cartels were the pinnacle of mercantilist logic and the cause of its eventual downfall. So, what was the ultimate return on investment for the 300-year project of the Spice Cartel? Geopolitically, it irrevocably reshaped the planet. It shifted the economic center of gravity from the Mediterranean to the Atlantic, catapulting Portugal, the Netherlands, and England to global prominence while bankrupting Venice. It created the first truly globalized economic system, linking Asian production to European consumption via capital-intensive, state-backed logistics. It redrew the world map, not with contours of continents, but with shipping lanes, fortified ports, and spheres of monopolistic influence. Financially, its legacy is our modern world. It birthed the corporate form, the stock market, and derivative instruments, the essential machinery of capital markets. It pioneered the model of shareholder capitalism and venture capital funding for high-risk, high-reward ventures. But the human and moral cost was a planetary debt. The profit margins were a mirage, sustained only by extreme violence and engineered scarcity. When the bubble finally burst from overproduction, it left behind bankrupt corporations, a world scarred by the model of extractive colonialism, and economic relationships poisoned by centuries of coercive trade. The Spice Cartel proved a timeless, grim lesson. Sufficient concentrated capital, backed by sufficient organized violence, can redesign global commerce for a generation. It can build empires and invent financial tools of breathtaking sophistication. But it also proved that no monopoly margin is eternal. Markets correct. Competitors emerge. Technological diffusion, like smuggling a nutmeg seedling, breaks artificial scarcity. The final ironic lesson is one of creative destruction. The very financial and corporate innovations the spice trade spawned, liquid capital markets. The joint stock company would eventually give rise to the free market ideologies and competitive pressures that dismantled such monopolies from within. The quest for 400% profit launched the age, but the inevitable force of market economics ultimately defined its end, leaving behind a world forever connected, forever unequal, and forever grappling with the tools of wealth and power it invented. The Spice Cartel reveals a fundamental truth. World history is often driven by ledger books, not legend. The compass, the caravel, the courage, all were merely tools in service of the profit margin. From the Portuguese monopoly to the VOC's corporate sovereignty and the EIC's strategic pivot, this was a 300-year masterclass in monopoly strategy, financial innovation, and brutal market dominance. It built our world, for better and infinitely for worse. If you found this dissection of history's first megacorporations revealing, your next essential chapter awaits. Next week, we dive into the Mississippi bubble, the derivative scam that bankrupted France. We'll see how the financial tools born from the spice trade were turned into weapons of mass economic destruction. Subscribe to Blood Money Files and hit the bell. The ledger always tells the true story.